Gildan Media, a division of Recorded Books, presents Advances in Financial Machine Learning by Marcos Lopez De Prado, narrated by Stephen J. Cohen. Publisher's note: this audiobook has bonus material. Please contact whomever you purchase this audiobook from to request the material. There are very few things which we know which are not capable of being reduced to a mathematical reasoning, and when they cannot, it's a sign our knowledge of them is very small and confused. Where a mathematical reasoning can be had, it's as great a folly to make use of any other as to grope for a thing in the dark when you have a candle standing by you. Of the Laws of Chance. Preface, 1692. John Arbuthnot, 1667 to 1735. Preamble. Chapter 1. Financial Machine Learning as a Distinct Subject. 1.1. Motivation. Machine learning, ML, is changing virtually every aspect of our lives. Today, ML algorithms accomplish tasks that until recently only expert humans could perform. As it relates to finance, this is the most exciting time to adopt a disruptive technology that will transform how everyone invests for generations. This book explains scientifically sound ML tools that have worked for me over the course of 2 decades and have helped me to manage large pools of funds for some of the most demanding institutional investors. Books about investing largely fall in one of 2 categories. On one hand, we find books written by authors who have not practiced what they teach. They contain extremely elegant mathematics that describes a world that does not exist. Just because a theorem is true in a logical sense does not mean it is true in a physical sense. On the other hand, we find books written by authors who offer explanations absent of any rigorous academic theory. They misuse mathematical tools to describe actual observations. Their models are overfit and fail when implemented. Academic investigation and publication are divorced from practical application to financial markets, and many applications in the trading investment world are not grounded in proper science. A first motivation for writing this book is to cross the proverbial divide that separates academia and the industry. I have been on both sides of the rift, and I understand how difficult it is to cross it and how easy it is to get entrenched on one side. Virtue is in the balance. This book will not advocate a theory merely because of its mathematical beauty, and will not propose a solution just because it appears to work. My goal is to transmit the kind of knowledge that only comes from experience, formalized in a rigorous manner. A second motivation is inspired by the desire that finance serves a purpose. Over the years, some of my articles published in academic journals and newspapers have expressed my displeasure with the current role that finance plays in our society. Investors are lured to gamble their wealth on wild hunches originated by charlatans and encouraged by mass media. One day in the near future, ML will dominate finance, science will curtail guessing, and investing will not mean gambling. I would like the listener to play a part in that revolution. A third motivation is that many investors fail to grasp the complexity of ML applications to investments. This seems to be particularly true for discretionary firms moving into the quantum mental space. I am afraid their high expectations will not be met, not because ML failed, but because they used ML incorrectly. Over the coming years, many firms will invest with off-the-shelf ML algorithms, directly imported from academia or Silicon Valley, and my forecast is that they will lose money to better ML solutions. Beating the wisdom of the crowds is harder than recognizing faces or driving cars. With this book, my hope is that you will learn how to solve some of the challenges that make finance a particularly difficult playground for ML, like backtest overfitting. Financial ML is a subject in its own right, related to but separate from standard ML, and this book unravels it for you. 1.2 The main reason financial machine learning projects usually fail. The rate of failure in quantitative finance is high, particularly so in financial ML. The few who succeed amass a large amount of assets and deliver consistently exceptional performance to their investors. However, that is a rare outcome, for reasons explained in this book. Over the past 2 decades, I have seen many faces come and go, firms started and shut down. In my experience, there is one critical mistake that underlies all those failures. 1.2.1 The Sisyphus Paradigm. Discretionary portfolio managers, PMs, make investment decisions that do not follow a particular theory or rationale. If there were one, they would be systematic PMs. They consume raw news and analyses, but mostly rely on their judgment or intuition. They may rationalize those decisions based on some story, but there is always a story for every decision. Because nobody fully understands the logic behind their bets, investment firms ask them to work independently from one another, in silos, to ensure diversification. If you have ever attended a meeting of discretionary PMs, you probably noticed how long and aimless they can be. Each attendee seems obsessed about one particular piece of anecdotal information, and giant argumentative leaps are made without fact-based empirical evidence. This does not mean that discretionary PMs cannot be successful. On the contrary, a few of them are. The point is, they cannot naturally work as a team. Bring 50 discretionary PMs together, and they will influence one another until eventually you are paying 50 salaries for the work of one. Thus, it makes sense for them to work in silos, so they interact as little as possible. Wherever I have seen that formula applied to quantitative or ML projects, it has led to disaster. The boardroom's mentality is, let us do with quants what has worked with discretionary PMs. Let us hire 50 PhDs and demand that each of them produce an investment strategy within 6 months. This approach always backfires because each PhD will frantically search for investment opportunities and eventually settle for 1, a false positive that looks great in an overfit backtest, or 2, standard factor investing, which is an overcrowded strategy with a low Sharpe ratio, but at least has academic support. Both outcomes will disappoint the investment board, and the project will be canceled. Even if 5 of those PhDs identified a true discovery, the profits would not suffice to cover the expense of 50, so those 5 will relocate somewhere else, searching for a proper reward. 1.2.2 The Meta-Strategy Paradigm. If you have been asked to develop ML strategies on your own, the odds are stacked against you. It takes almost as much effort to produce one true investment strategy as to produce 100, and the complexities are overwhelming. Data curation and processing, HPC infrastructure, software development, feature analysis, execution simulators, backtesting, etc. Even if the firm provides you with shared services in those areas, you are like a worker at a BMW factory who has been asked to build an entire car by using all the workshops around you. One week, you need to be a master welder. Another week, an electrician. Another week, a mechanical engineer. Another week, a painter. You will try, fail, and circle back to welding. How does that make sense? Every successful quantitative firm I am aware of applies the meta-strategy paradigm. Lopez De Prado, 2014. Accordingly, this book was written as a research manual for teams, not for individuals. Through its chapters, you will learn how to set up a research factory, as well as the various stations of the assembly line. The role of each quant is to specialize in a particular task, to become the best there is at it, while having a holistic view of the entire process. This book outlines the factory plan, where teamwork yields discoveries at a predictable rate, with no reliance on lucky strikes. This is how Berkeley Lab and other U.S. national laboratories routinely make scientific discoveries, such as adding 16 elements to the periodic table or laying out the groundwork for MRIs and PET scans. No particular individual is responsible for these discoveries, as they are the outcome of team efforts where everyone contributes. Of course, setting up these financial laboratories takes time and requires people who know what they are doing and have done it before. But what do you think has a higher chance of success? This proven paradigm of organized collaboration, or the Sisyphean alternative of having every single quant rolling their immense boulder up the mountain? 1.3 Book Structure. This book disentangles a web of interconnected topics and presents them in an ordered fashion. Each chapter assumes that you have heard the previous ones. Part 1 will help you structure your financial data in a way that is amenable to ML algorithms. Part 2 discusses how to do research with ML algorithms on that data. Here, the emphasis is on doing research and making an actual discovery through a scientific process, as opposed to searching aimlessly until some serendipitous, likely false, result pops up. Part 3 explains how to backtest your discovery and evaluate the probability that it is false. These 3 parts give an overview of the entire process, from data analysis to model research to discovery evaluation. With that knowledge, Part 4 goes back to the data and explains innovative ways to extract informative features. Finally, much of this work requires a lot of computational power, so Part 5 wraps up the book with some useful HPC recipes. 1.3.1 Structure by Production Chain. Mining gold or silver was a relatively straightforward endeavor during the 16th and 17th centuries. In less than 100 years, the Spanish treasure fleet quadrupled the amount of precious metals in circulation throughout Europe. Those times are long gone, and today prospectors must deploy complex industrial methods to extract microscopic bullion particles out of tons of earth. That does not mean that gold production is at historic lows. On the contrary, nowadays, miners extract 2,500 metric tons of microscopic gold every year, compared to the average annual 1.54 metric tons taken by the Spanish conquistadors throughout the entire 16th century. Visible gold is an infinitesimal portion of the overall amount of gold on Earth. El Dorado was always there, if only Pizarro could have exchanged the sword for a microscope. The discovery of investment strategies has undergone a similar evolution. If a decade ago it was relatively common for an individual to discover macroscopic alpha, for example, using simple mathematical tools like econometrics, currently the chances of that happening are quickly converging to zero. Individuals searching nowadays for macroscopic alpha, regardless of their experience or knowledge, are fighting overwhelming odds. The only true alpha left is microscopic, and finding it requires capital-intensive industrial methods. Just like with gold, microscopic alpha does not mean smaller overall profits. Microscopic alpha today is much more abundant than macroscopic alpha has ever been in history. There is a lot of money to be made, but you will need to use heavy ML tools. Let us review some of the stations involved in the chain of production within a modern asset manager. 1.3.1.1 Data Curators. This is the station responsible for collecting, cleaning, indexing, storing, adjusting, and delivering all data to the production chain. The values could be tabulated or hierarchical, aligned or misaligned, historical or real-time feeds, etc. Team members are experts in market microstructure and data protocols, such as FIX. They must develop the data handlers needed to understand the context in which that data arises. For example, was a quote canceled and replaced at a different level or canceled without replacement? Each asset class has its own nuances. For instance, bonds are routinely exchanged or recalled. Stocks are subjected to splits, reverse splits, voting rights, etc. Futures and options must be rolled. Currencies are not traded in a centralized order book. The degree of specialization involved in this station is beyond the scope of this book, and Chapter 1 will discuss only a few aspects of data curation. 1.3.1.2 Feature Analysts. This is the station responsible for transforming raw data into informative signals. These informative signals have some predictive power over financial variables. Team members are experts in information theory, signal extraction and processing, visualization, labeling, weighting, classifiers, and feature importance techniques. For example, feature analysts may discover that the probability of a sell-off is particularly high when 1. Quoted offers are canceled, replaced with market sell orders, and 2. Quoted buy orders are canceled, replaced with limit buy orders deeper in the book. Such a finding is not an investment strategy on its own and can be used in alternative ways. execution, monitoring of liquidity risk, market making, position taking, etc. A common error is to believe that feature analysts develop strategies. Instead, feature analysts collect and catalog libraries of findings that can be useful to a multiplicity of stations. Chapters 2 through 9 and 17 through 19 are dedicated to this all-important station. 1.3.1.3 Strategists. In this station, informative features are transformed into actual investment algorithms. A strategist will parse through the libraries of features looking for ideas to develop an investment strategy. These features were discovered by different analysts studying a wide range of instruments and asset classes. The goal of the strategist is to make sense of all these observations and to formulate a general theory that explains them. Therefore, the strategy is merely the experiment designed to test the validity of this theory. Team members are data scientists with a deep knowledge of financial markets and the economy. Remember, the theory needs to explain a large collection of important features. In particular, a theory must identify the economic mechanism that causes an agent to lose money to us. Is it a behavioral bias, asymmetric information, regulatory constraints? Features may be discovered by a black box, but the strategy is developed in a white box. Gluing together a number of cataloged features does not constitute a theory. Once a strategy is finalized, the strategist will prepare code that utilizes the full algorithm and submit that prototype to the backtesting team described later. Chapters 10 and 16 are dedicated to this station, with the understanding that it would be unreasonable for a book to reveal specific investment strategies. 1.3.1.4 Backtesters. This station assesses the profitability of an investment strategy under various scenarios. One of the scenarios of interest is how the strategy would perform if history repeated itself. However, the historical path is merely one of the possible outcomes of a stochastic process and not necessarily the most likely going forward. Alternative scenarios must be evaluated, consistent with the knowledge of the weaknesses and strengths of a proposed strategy. Team members are data scientists with a deep understanding of empirical and experimental techniques. A good backtester incorporates in his analysis meta-information regarding how the strategy came about. In particular, his analysis must evaluate the probability of backtest overfitting by taking into account the number of trials it took to distill the strategy. The results of this evaluation will not be reused by other stations, for reasons that will become apparent in Chapter 11. Instead, backtest results are communicated to management and not shared with anyone else. Chapters 11 through 16 discuss the analyses carried out by this station. 1.3.1.5 Deployment Team. The deployment team is tasked with integrating the strategy code into the production line. Some components may be reused by multiple strategies, especially when they share common features. Team members are algorithm specialists and hardcore mathematical programmers. Part of their job is to ensure that the deployed solution is logically identical to the prototype they received. It is also the deployment team's responsibility to optimize the implementation sufficiently such that production latency is minimized. As production calculations often are time-sensitive, this team will rely heavily on process schedulers, automation servers, Jenkins, vectorization, multithreading, multiprocessing, graphic processing unit, GPU, NVIDIA, distributed computing, Hadoop, high-performance computing, Slurm, and parallel computing techniques in general. Chapters 20 through 22 touch on various aspects interesting to this station as they relate to financial ML. 1.3.1.6 Portfolio Oversight. Once a strategy is deployed, it follows a cursus honorum, which entails the following stages or life cycle. 1. Embargo. Initially, the strategy is run on data observed after the end date of the backtest. Such a period may have been reserved by the backtesters, or it may be the result of implementation delays. If embargoed performance is consistent with backtest results, the strategy is promoted to the next stage. 2. Paper trading. At this point, the strategy is run on a live, real-time feed. In this way, performance will account for data parsing latencies, calculation latencies, execution delays, and other time lapses between observation and positioning. Paper trading will take place for as long as it is needed to gather enough evidence that the strategy performs as expected. 3. Graduation. At this stage, the strategy manages a real position, whether in isolation or as part of an ensemble. Performance is evaluated precisely, including attributed risk, returns, and costs. 4. Reallocation. Based on the production performance, the allocation to graduated strategies is reassessed frequently and automatically in the context of a diversified portfolio. In general, a strategy's allocation follows a concave function. The initial allocation at graduation is small. As time passes and the strategy performs as expected, the allocation is increased. Over time, performance decays and allocations become gradually smaller. 5. Decommission. Eventually, all strategies are discontinued. This happens when they perform below expectations for a sufficiently extended period of time to conclude that the supporting theory is no longer backed by empirical evidence. In general, it is preferable to release new variations of a strategy and run them in parallel with old versions. Each version will go through that life cycle, and old strategies will receive smaller allocations as a matter of diversification, while taking into account the degree of confidence derived from their longer track record. 1.3.2 Structure by Strategy Component. Many investment managers believe that the secret to riches is to implement an extremely complex ML algorithm. They are setting themselves up for a disappointment. If it was as easy as coding a state-of-the-art classifier, most people in Silicon Valley would be billionaires. A successful investment strategy is the result of multiple factors. Table 1.1 in the bonus PDF summarizes what chapters will help you address each of the challenges involved in developing a successful investment strategy. Throughout the book, you will find many references to journal articles I have published over the years. Rather than repeating myself, I will often refer you to one of them, where you will find a detailed analysis of the subject at hand.
Sample complete. Ready to continue?